Stock of the Day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
So our stock of the day is Integral Diagnostics. This comes after the ACCC said that it will not oppose its acquisition of Capital Health. The merger has been cleared on the basis of an undertaking provided by Integral to the competition regulator in relation to the divestment of Capital's clinic in Melton, Victoria. So Capital will now apply to the Federal Court of Australia to approve the scheme, with its implementation expected soon, in fact, on the 20th of December 2024. Alongside that, we did have Barrenjoey upgrading Integral through its most recent view or note coming through on the company. So I thought we should ask our guests about this one, and I will begin with Andrew Wielandt from DP Wealth Advisory. What do you think?
I was hoping you'd start with me, Nadine. Look, it certainly is a positive, and the share price is reflecting that, up about 2.5–3% today. And it's an interesting new business. IDX will own about 2/3 of it, 63%, and the old Capital Health will be 37%. Probably the key thing is the efficiency piece. You got 155 clinics, you got 350 radiologists, 3,000 employees, and around $650 million in revenue. So certainly scaling that business up. The ROE in IDX lane, those pretty underwhelming. It's about 5% and only a 4% margin. So again, this merger you would see is potentially a positive for them to try and drive some cost efficiencies to try and get those sort of numbers up. I think probably the other benefit I see is just from a market pricing point of view. They're trading quite low on a PE basis relative to their peers. Peers are trading at sort of in that healthcare space at around 30–35 times earnings. PE forecast to be around 20 times. So it's trading well under, and yet the forecast earnings per share growth by virtue of having these two businesses together is around 30%. So in other words, you've got a company that's reasonably cheap, but whenever there's mergers, acquisitions, it takes 12 to 18 months for the cost efficiencies to wash through the merging of those cultures and all that type of thing. So on balance, it's a hold, but if they can drive through those cost efficiencies and certainly get the moulding of that culture together by virtue of some of those numbers we were talking about, it looks like an interesting business. It's probably just a bit too soon yet.
Got it. Well, year to date, share price is up by 57%.
It's interesting when you look at those compared to Sonic with their kind of business, which hasn't really done an awful lot. I guess the key to this is going to be execution, and as Andrew says, it's always hard putting two of these sort of companies together, and they talk about the synergies, but you've got to actually get those synergies, and there's egos at play, there's some management disruptions. But clearly, scale is a good thing, and if they can drive those synergies, that will be good for the whole business. At the end of the day, I think this is one of the businesses that's going to be really impacted, I guess, by AI, and we're already seeing that, I guess, and that's going to help the efficiencies. So I'm with Andrew with these two in terms of a hold for them or it as it becomes. I think it delists just before Christmas, so you will just have the one stock to contend with.
Got it. So that is a view hold, solid hold from both of my guests.
The Stock of the Day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at IG.com.